Welcome to Cashflow Positive, your trusted source for all things finance and investing. Today we're peeling back the layers on how to become a better stock investor in 2024. As we journey through this informative video, we'll provide clear, easy-to-follow steps to help you enhance your investing prowess. From understanding the basics to the importance of patience and discipline, we've got it all covered. So, buckle up as we delve into the world of stock investing. First things first, understanding the basics is key. We're talking about the very foundation of your investment journey, the concept of stocks. Stocks represent ownership in a company. When you buy a stock, you're buying a piece of that company, becoming a shareholder. Now, stocks come in different flavors. There are common stocks where you get voting rights and a chance to share in the company's success through dividends and capital appreciation. Then, there are preferred stocks. With these, you don't get voting rights, but you do get a higher claim on profits and assets. That means you'll get paid dividends before common stockholders and have a higher claim in case the company goes bankrupt. But wait, there's more. Beyond these basic types, stocks can be further categorized based on company size, sector, growth potential, and even geographical location. Each category comes with its own set of risks and rewards. Understanding these basics is like learning the alphabet before writing a novel. It equips you with the knowledge to make informed decisions and navigate the stock market with confidence. Whether you're aiming for short-term gains or long-term growth, getting these fundamentals right is a crucial first step. And remember, the stock market isn't a get-rich-quick scheme. It's a platform for investing in businesses and sharing in their success. So arm yourself with knowledge and approach it with respect. Remember, a house is only as strong as its foundation. Next, we move into the realm of research and analysis. Imagine walking into a bookstore with thousands of books but no categories or labels. Where would you start? That's what investing can feel like without proper research and analysis. It's a crucial step that can't be overlooked. Let's start with researching the companies you're interested in. This isn't just about knowing what the company does. It's about understanding their business model, their competitive edge, and their growth prospects. You might want to dive into their annual and quarterly reports, their earnings calls, and even news articles about them. It's like doing a deep dive into the life of a person before deciding to marry them. The more you know, the better equipped you are to make a decision. Next, analyze their financial health. Are they profitable? Do they have a healthy balance sheet? Are they heavily in debt? These are all questions you need to answer. A company might have a great product, but if they're drowning in debt, it could spell trouble. Understanding their market position is equally important. Are they a dominant player? Or are they a small fish in a big pond? Knowing where they stand can give you a sense of their potential for growth and risk level. Now let's talk about fundamental and technical analysis. Fundamental analysis is like being a detective. You're looking at the company's earnings, revenues, assets, and liabilities to determine its intrinsic value. On the other hand, technical analysis is more like being a weather forecaster. You're studying past market data, primarily price and volume, to predict future price trends. Both types of analysis have their merits, and most successful investors use a combination of the two. Remember, the goal here isn't to predict the future. It's about making an educated guess based on the information available. Armed with knowledge, you're now ready to make informed decisions. Investing isn't a game of chance, it's a strategic move that requires careful thought and analysis. So roll up your sleeves, do your homework, and let your analysis guide your investment decision. Now, let's talk about diversification. As we delve further into the world of investing, it's crucial to understand this concept. Diversification, in the simplest of terms, is the strategy of spreading your investments across various assets to reduce risk. It's the embodiment of the old adage, don't put all your eggs in one basket. Think of it this way. Suppose you have a basket filled with a variety of fruits, apples, oranges, bananas, and berries. If one type of fruit, say the berries, were to go bad, you'd still have the other fruits to enjoy. On the other hand, if you only had berries in your basket and they went bad, you'd be left with nothing. The same principle applies to investing. If you invest all your money in one company or sector and it tanks, you could lose everything. But if you diversify, spreading your investments across different companies, industries, and even countries, you reduce the risk of a total loss. Diversification isn't just about minimizing risk though, it can also help maximize returns. By investing in a range of assets, you increase your chances of holding the fruit that performs exceptionally well. Maybe the tech sector outperforms one year, or a small company in your portfolio experiences explosive growth. By having a piece of many pies, you give yourself more opportunities for success. Of course, successful diversification isn't about randomly picking investments. It requires careful research and planning. You'll need to consider factors like your risk tolerance, investment goals, and time horizon. And remember, diversification isn't a one-time thing. As markets change, you'll need to adjust your portfolio accordingly, always keeping an eye on the balance between risk and reward. We should also note that diversification doesn't guarantee profits or protect against all losses. Like any investment strategy, it has its limitations. But when used wisely, it can be a powerful tool in managing risk and potentially enhancing returns. Diversification is not just a strategy, it's an investor's best friend. So, as you navigate the ever-evolving landscape of stock investing, remember to spread your eggs across different baskets. It's one of the best ways to ensure that your investment journey is a fruitful one. Patience and discipline, the two pillars of successful investing. Let's dive deep into these two significant aspects. Patience. It's more than just a virtue in the world of investing. It's a necessity. The stock market isn't a get-rich-quick scheme. It's a platform for wealth creation over time, which requires a long-term perspective. You see, stock prices don't always reflect a company's intrinsic value. Sometimes they're undervalued, other times overvalued. Patience is the ability to wait for the right investment opportunity, to let the market price converge with the intrinsic value. It's about resisting the urge to make hasty decisions during market highs and lows. This brings us to the second pillar, discipline. It's the backbone of any investment strategy. It's about sticking to your investment plan regardless of market noise. Let's say you've decided to invest a fixed amount every month in a particular stock. Now the market is volatile, the prices are fluctuating, and the media is buzzing with speculations. It's easy to be swayed, isn't it? But here's where discipline comes into play. It's about maintaining consistency, no matter what. It's about not letting short-term market movements affect your long-term strategy. But how do you cultivate patience and discipline, you ask? Well, it starts with having a clear understanding of your financial goals and risk appetite. It's about knowing why you're investing and what you're investing in. It's about being confident in your research and analysis. Remember, the stock market is a marathon, not a sprint. It's about steady progress, not immediate gains. It's about resisting the temptation of quick profits and avoiding the fear of temporary losses. It's about understanding that market downturns are part and parcel of the investment journey. So, next time you're tempted to make a hasty decision, take a step back. Remind yourself of your financial goals, trust your investment plan, and above all, have patience and discipline. Remember, Rome wasn't built in a day, and neither is wealth. Finally, let's discuss the importance of regular review and learning. In the world of investing, staying static is a recipe for failure. The market is a dynamic entity, always shifting, always evolving. It's a living, breathing organism that requires your constant attention. Regular review of your investment portfolio is not just recommended, it's essential. It's like checking the health of your investments. You wouldn't ignore a persistent cough or a nagging pain, would you? Your investments demand the same level of care. Regular review helps you identify what's working, what's not, and where you need to make adjustments. And remember, adjusting your strategy doesn't mean you failed. It simply means you're responsive and adaptable. You're paying attention to the market's signals and responding appropriately. But regular review is only half the battle. The other half is continuous learning. The financial market is an ocean of knowledge, and you are but a single vessel navigating its vast expanse. The more you learn, the better equipped you'll be to navigate the market's capricious waves. Stay abreast of the latest trends, read widely, attend seminars, listen to podcasts, engage in discussions. Knowledge is power, and in the financial market, it's your most valuable asset. So there you have it. Regular review and continuous learning, the two pillars of successful investing. Remember, the market waits for no one, it's constantly moving, constantly changing, And the only way to keep up is to stay on your toes, stay curious, stay informed, and keep learning. And that's your guide to becoming a better stock investor in 2024. Remember, understanding the basics, conducting thorough research and analysis, diversifying your portfolio, maintaining patience and discipline, and regularly reviewing and learning from your investments are all key ingredients to your success. Don't forget to subscribe to Cashflow Positive for more interesting facts on finance, and if you found this content useful, hit the thumbs up button. It really helps the channel. Until next time, keep investing and stay cashflow positive.